Hello everyone, and welcome to this session in which we will discuss contingent liabilities. Contingent liabilities is another form of liabilities. Just like estimated liabilities and known liabilities, we have something called contingent liabilities. When you think of contingent liabilities, think of a lawsuit or an environmental cleanup. For example, a company might be sued, but it does not know if it will win or lose. And if it loses, it does not know how much it might have to pay. Or the company might have to clean up an environmental hazard accident, but it does not know how much it will cost them. From an accounting perspective, the company must evaluate the probability of a future loss. To do so, the company will categorize the likelihood, the probability of the loss into three levels: remote, possible, and probable. Under remote, we mean very low probability. Well, we can say 0 to 5%. Although these percentages don't exist, I'm giving you 0 to 5% to tell you it's a low probability, just to kind of give you the idea. If the probability is remote, you'll be told so in the problem. You do nothing. You don't have to disclose it. You don't have to book any liability. You don't have to book any expense. It's like as if never happened. Companies get sued all the time. And if it's remote, it's remote. Possible means moderate probability. If the loss is possible, think about 50% losing. We might lose, we might win, we don't know. What do you have to do if it's possible? What you have to do if it's possible is to disclose this information in the notes of the financial statement. This will include who's suing you, in which court, for what purpose, detailed about the case, and you would say we don't know the outcome, and the outcome might be in 2-3 years or whatever. This way you give the users of the financial statement an idea that you are being sued. The third possibility is probable. It means a high probability you are going to lose. If the loss is probable, let's say 90% chance. And how do we know this? Well, all the scientific evidence, all the evidence has been stacking against us. We know we are going to lose. So the first thing we determine is, what is the amount of the loss? Can we estimate the loss? If the loss cannot be estimated, we don't know the dollar amount, then all what we do is we disclose, just like in the possible. If we know the dollar amount, then we will have to book a liability. We have to debit an expense and credit a liability. Basically debit some sort of a lawsuit expense, credit a lawsuit payable, and estimate the amount. So what you need to know is this. The takeaway from this is this. You only record a liability when two conditions exist. One, it's probable. Probable means there's a high chance you are going to lose. Fine. Second is you know the dollar amount. Once those two items are known, you have a liability to book. You debit an expense, credit a liability. Now let's go ahead and discuss additional contingent liabilities, and we'll work an example to illustrate this concept at the end. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Hello. My name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel, and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
Legal claims. If the company is likely to lose a lawsuit and the loss is measurable, it should record it as a liability. What did we say? It's measurable and probable. I kept it outside to write it down to remind you. To record a liability, you have to have two conditions: measurable plus probable. Probable means a high probability. What's a high probability? It's a judgment. I said, over 90%. Could be 85%, could be 90, 95. High probability you are going to lose. And you can measure it, you know the amount. The second type of estimated liabilities are debt guarantees. Same concept. Debt guarantees, minimum you have to put in the notes. You have to tell us if you are guaranteeing the debt of another company. Now, if it's a probable, the other company is not going to pay the debt that you guaranteed. What's a debt guaranteed? It means when another company comes to you and say, we want to get a loan, but they will not, the bank will not give us a loan unless we have someone guaranteeing the loan. And the company would agree to guarantee a loan of another company. Now, why would they do that? Could be many reasons. It could be the company that you are guaranteeing the loan for is your supplier. And you want to make sure they have the money so they keep supplying you with the goods that you need to manufacture your product. It could be that the board of directors of both companies are interrelated, or somehow these two companies are interrelated. So what you do is one company will guarantee the debt of another company. If that party is likely to default, it means if the party that you guarantee the debt for is likely, there's a chance they are going to default. Default means they cannot pay off their debt. The guaranteeing company must disclose and possibly record a liability. It means if there is a chance they are going to default and you're going to have to come up with the money, because if you guaranteed the debt, the bank don't care. The bank, if the original party don't pay, they go over the guarantor. And that's why they ask for a guarantor, because they don't trust that company in the first place. So the other company is responsible for the debt. A good case is Enron. It's beyond the scope of this course, but this is what Enron used to do. Enron used to create, so if this is Enron, if this is the main company Enron, I'm sure you heard of it, they would create sub-companies, companies that are related to Enron, and those companies would borrow money, Enron would guarantee them, but somehow Enron would hide this debt. Because if they guarantee the debt, that should be Enron's debt. They found accounting loopholes to cover the debt. If you want to learn about this more, go to my advanced accounting. It's beyond the scope of this course. Another example of contingent liabilities is environmental obligation. Should an environmental cleanup be probable and the cost is estimatable, a liability is recorded. A case in point is British Petroleum. When they had that oil spill in the Gulf of Mexico, they estimated, I believe, either 20 or 40 billion dollars in cleanup cost. So that was an a contingent liability, but that was probable, and they estimated the amount. We want to make sure we distinguish between contingencies, which is kind of waiting for something else, and uncertainties. We have many uncertainties in life. Anything is uncertain. So it's crucial to differentiate between those two. So contingencies depends on the outcome of an existing situation. So you have something existing right now and you're waiting for the outcome. This is how we define contingencies. Uncertainties involve predicting future event. Uncertainties are not recorded. You cannot predict or disclose it as a liability if it does not stem for an event that already existed with a probable loss. So you have to have something that already existed. So economic conditions, technological changes, natural disaster, fire, theft, those, they all could happen, but they are not contingent liabilities. They are considered uncertainties. And for uncertainties, we don't disclose, we don't record. We just simply, life is uncertain. We can go forever and list uncertainties and keep booking liabilities if that's what we want to do. Let's take a look at an example of contingent liability. TechCorp, a technology company, is currently facing a lawsuit for a patent infringement. And that's a classic case. Whether it's Apple, Samsung, they always face this patent infringement where they invented something and another company claimed they invented it before them and they sue each other. Then they have a lawsuit. Then they face lawsuits. The company's legal team believe there's a 60% chance of losing the case, and they estimate the loss to be $500,000. Okay? And the financial statements are due soon, and then management must decide how to handle the situation. So here's what's going to happen. For 60%, it's kind of close to the middle. It's not a low chance. It's not really a high chance. It's in the middle. What do you do? If we assume 60% is in the middle, we disclose. That's the minimum. We disclose. Now, if you want to be conservative, you just book the liability. No one's going to stop you if you just want to go to the other extreme. But I think if there's a 60% chance, again, in the real literature, there's no percentages. It's a judgment. Assume the legal team estimate there's a 95% chance we are losing the case and it's going to cost us $500,000. Come on. 95% chance, you got to not only disclose, obviously you have to disclose, but you have to debit an expense and credit a liability. You have no choice here. You are going to lose. Now, you don't, obviously when you get to that point, all the evidence is stacked against you and, you're going to be losing. Everyone knows it because, the court already looked at the evidence and, any judge or any jury with any common sense, they're going to rule against you. You know that now. Therefore, you debit an expense, credit a liability before the judgment is made. Now, would the judge or the jury rule in your favor? It could be. You just reverse it. You remove the expense, you remove the liability. It could happen. Your expense could be a little bit higher. Your expense could be a little bit lower. But guess what? Show the expense, let the investors know that you're facing a lawsuit and there's a good chance you might lose, so they decide properly whether they want to invest in your company or not. What should you do now? You want to go to Farhat Lectures, look at additional MCQs, resources that's going to help you, especially if you are a financial accounting student or studying for your accounting professional certification, taking this as a professional development or whatever reason. Invest in yourself. Good luck and of course, stay safe.